After a steep sell-off, KUKE Music Holding Limited Spon Ads Each Rep 10 is back on everyone's radar. That drop may feel scary, but it can also be a reset that sets up an attractive risk-reward if a few constructive signs begin to line up. KUKE Music Holding Limited SA operates in the music and entertainment sector, focused on the distribution, licensing and monetization of recorded music and related content. Its business model centers on generating recurring revenue from licensing deals, streaming royalties, and partnerships with content platforms and publishers. Revenue drivers typically include catalog monetization, new licensing agreements, synchronization deals for film and advertising, and expansion into regional markets. Strategically, KUKE aims to expand its rights portfolio, increase recurring streams of royalty income, and build partnerships that scale distribution while keeping overhead lean. The company's mission is to turn intellectual property into predictable cash flows through rights management and platform tie-ins, a playbook that benefits from long-term consumption trends in music and digital content. I checked the latest RSS news feed for KUKE and did not find recent constructive headlines to cite. No confirmed new contracts, insider buys, buybacks, or guidance reaffirmations were returned. Because the feed was clear of positive items, I'll highlight the kinds of concrete, constructive signals investors should watch for and why each would matter. 1. New licensing or distribution deals. A fresh agreement with a major streaming platform, a TV film sync deal, or regional distribution partnership would translate directly into near-term revenue visibility and recurring royalties. This signals demand for KUKE's catalogue and can reprice investor expectations. 2. Buybacks, insider purchases, management show of confidence. Any buyback authorization or insider buying is a direct signal that insiders view the equity as undervalued and believe in the company's cash generation. That often reassures the market and supports a price floor. 3. Liquidity actions and debt management. Announcements that improve the balance sheet, refinancing debt at better rates, securing a credit line, or revealing a strong cash runway reduce existential worries and let investors focus on growth again. 4. Product or platform rollouts. Launches that improve royalty collection, analytics for rights monetization, or new distribution channels can expand margin and scalability. Each one of these, if reported, would be a constructive catalyst that could help turn a sell-off into a recovery. The broader tailwinds for KUKE's sector remain intact. Global streaming continues to grow, playlists and sync placements generate new revenue channels, and the value of well-managed music catalogs has become more recognized by investors and strategic buyers. If KUKE can demonstrate steady catalogue monetization, grow licensing wins, or prove higher take rates on streams, sentiment can shift. Also, the sell-off may have compressed expectations. Investors who push the price down often price in execution risk. That creates a lever. Concrete operational wins or partnership announcements can generate outsized sentiment change versus the size of the actual business improvement. Near-term catalysts to monitor include quarterly results that show royalty growth or margin stabilization, any announced licensing deals, and management commentary on monetization initiatives. Over the medium term, successful scaling of distribution partnerships and stronger recurring revenue mix would be the most durable growth drivers. Why KUKE could rebound? 1. Rights ownership is sticky revenue. Once licensing deals are signed, royalties tend to be recurring. That predictability can convert into smoother revenue streams over time. 2. Multiple levers to improve cash flow. KUKE has pathways to increase per-catalogue yield. Better royalty collection, sync licensing, and selective catalogue acquisitions, coupled with cost discipline, can help margins. 3. Sector re-rating potential. If the company begins to deliver consistent top-line growth and demonstrates margin improvement, the market has historically been willing to re-rate undervalued content-centric businesses. 4. Timing and sentiment. After a sharp drop, the catalysts listed earlier can have an amplified effect as investor psychology shifts from fear to recovery. For KUKE specifically, the path to recovery is about demonstrating that the revenue model is resilient, and that management has a credible plan to convert content rights into predictable cash flow. Those are measurable and communicable milestones. KUKE's recent sell-off is a reset, not the final sentence. If the company begins to check the boxes above, the combination of recurring royalties, higher margin monetization channels, and improved liquidity could justify renewed investor interest. Keep a checklist and watch for the specific, constructive announcements that validate a turnaround. If you found this breakdown helpful, like the video and subscribe for more calm, catalyst-focused recovery setups. Share in the comments the top catalyst you're watching for KUKE and why. This video is for informational and educational purposes only and should not be considered financial advice. Always do your own research before investing.